Can you see the slide now, the title slide? Tyler, Robert?
Yeah, I can see it.
Yeah. Okay, perfect. Okay, so what's gonna be your protocol for CE credit?
Just gotta make sure I can see their faces.
Okay,
And,
so you're gonna have to turn on your cameras at some point so he can see you. We're recording this, that you're here. You gotta stick around the whole time to get the CE credit, but he'll need your email and your license numbers in there. He may throughout the thing ask you to answer a question or something. Yeah, keyword, secret code for something. But we'll go ahead and get started. So Spencer's been here before. He's done some trainings for us, so you guys might recognize him. He's with Unified Lending. And so reverse mortgages is something he knows a lot about, and we're gonna rip into a 2-hour class. Okay, come up and share anything else you need to about your background, and then we'll get going. Oh, I love it when kids get on the screen too. Thanks, Tyler. Oh, sorry, I love babies. Okay, come on up, Spence.
Okay, all right. So, some notes. Slides.
Oh, perfect. Yeah, hand me one of those, Jesus.
Is
Hey, everybody.
Lindsay coming up?
I don't know, she's in a meeting with a couple of people in the office.
This goes-
Should be on
Advances
power.
slides.
Turn the power on. The top one. Did it vibrate?
Yeah, I did feel vibration.
Is there an age limit where like you cannot get mortgage? Like they're probably not
reverse
gonna give you
mortgage?
any mortgage if you're 80, huh?
Regular mortgage or
Uh-huh,
reverse
regular
mortgage?
No, there's a minimum age, but not a maximum. And that's part of what
You
he'll
can
get
be 90 years old and get a mortgage.
Nice, okay,
Yeah.
because I was telling my mom, like, I don't think they're gonna give you any mortgage because you're old.
It's actually made for her.
Okay, so let's go and get started. Let me just introduce myself a little bit to begin with. We have a really big audience here. For those of you on camera, there's a really big audience in person.
You're missing out. Should have been here in person.
So, but anyways, yeah, I've been here a couple times with some CE.
Mhm.
I really enjoy it. This is one of my favorite places to come teach. You guys have a good setup. It's awesome.
Awesome. Yeah, we love having you
You
here.
guys shop here. It's great. So other classes I've done, I have, let's see, managing your database to get referrals. I got that approved for CE, which is a fun one to teach. I did one on video marketing.
Video was good. That was a
Yeah,
good one.
did that one. That's a lot of fun. I have a Facebook one. I've got like understanding credit scores. Got that, which is kind of boring, but hey, it's CE. So
Hey, go to is Unified. What's your? Tell me your
Unified.
website.
Unified
Since you
Lending.
mentioned the video, you've got a good about us video.
Oh, yeah,
Your
yeah, yeah.
story stuff.
Yeah.
That was really good. You should
Yeah.
go check that out.
I do have a video of, I call it my about me video. I have it everywhere on my website, on my social media platforms, email signatures, everywhere. So if anybody connects with me, if not in person, then they can look at my about me video and get to know me. It's a 2-minute video about me personally, but also professionally, what I can do. So it's a lot of fun, but that's definitely a video that I'd recommend doing for your real estate business, if that is something.
Us too?
Yes,
Oh, totally.
absolutely, yeah.
You should watch it. And the website is.
Unifiedlending.com. Website is unifiedlending.com. I should put it on that first.
No, that's all right.
So
I just don't know if it was different.
yeah.
Unifiedlending.com.
Anyways, I really enjoy doing CE classes. This is a lot of fun. I love getting in front of good folks like you guys, the realtors, and I feel like if I'm helping you build your business, I can probably build my business along with you. And it's just a lot of fun. I enjoy teaching. This subject matter, reverse mortgage, is becoming extremely popular. I don't know if it's come up in your business at all, but
Boomers.
yeah. Reverse mortgages is something that is becoming a hot topic, especially with that age
Did you
demographic,
see? You've never heard of reverse
with the older folks.
You've never heard of reverse mortgage?
60s and 70s, 80s and whatnot. So, anyways, this is a 2-hour CE class, but there's a good chance we might end early. Are you guys okay with that if we end early? Okay, I'll still give you the 2
We just
hours
want the
of credit.
content, brother.
Yeah, I'll still give you the 2 hours of credit, but
Even better though, right?
maybe less than 2 hours.
Okay.
Just saying. So reverse mortgage. Also, again, just so you know, I need your name, your email, and your license number to get credit. The CE credit, that to bank those hours with the state. I got a list here of those in person, and then just make sure you put it in the chat or email me that information. So let's get started. Reverse mortgage. So 80 is the new 50. What do you think that means? What does that mean? 80 is the new 50.
People are living longer.
Yeah, bingo.
Yeah.
People are living longer.
Yeah.
It used to be, back in the 70s and 80s that, when you turned 80,
You were dead?
you're last leg,
You
right?
usually
You were
don't.
dead.
Now you turn 80 and, you've got like 20 years sometimes, but people living longer, which is a good thing, but it also comes with challenges too. We'll talk about that. Some statistics I thought were interesting. USA Today article notes senior population is growing at 3 times the rate of general population. So that is the truth, that the senior population, 60s, 70s, that age demographic, they're growing. That group, that age demographic is just growing exponentially right now. In 2020, US Census showed nearly 1/5 of the population are over 65.
Wow.
10,000 individuals turn 65 every day in the US.
What?
10,000 people turn 65 years old every single day. So it's crazy. 25% of all home buyers are age 60 and above.
That's huge.
25.
That was surprising to me. 25%. So one of every 4 home buyers right now are 60 years old and above. Wow. The demand for housing designed for senior Americans is growing and expected to continue to grow. So when you think about housing for senior Americans, like what does that mean? What is it? What would a house need to have to facilitate senior Americans?
I think like one level living for a lot of them, get
One
rid of
level.
stairs,
Less stairs.
ADA.
Yes. So no stairs,
small yard.
small yard,
Low
maybe
maintenance.
low maintenance. Exactly. That's exactly right. So this type of housing is a huge demand. It's getting worse and worse.
55 plus community, huh?
Yeah, exactly. So those are really hard to get.
We could use more of
Yeah.
them around
Yeah.
here for sure.
So they have a greater chance of living to age 100 than ever before. The average person, ages 56 to 61, has about $160,000 saved for retirement.
Mm.
So when you're 56 years old and you have 160,000, that might seem like a decent amount, but that's only really like $389 a month if you live to be 100 years old.
Wow.
Yeah.
So there's an issue. There's kind of an issue now with this age demographic where with inflation, things are just getting more expensive, but the income for this age demographic is not going up, right? In fact, it might be going down. So another few interesting statistics, 55 and 64-year-olds outspend the average consumer in nearly every category, including food away from home, household furnishings, entertainment, and personal care and gifts.
Mm.
So they're actually spending a lot of money,
Yeah.
but they don't really have tons of money.
Yeah.
So you think how where are they getting their money? It's probably going on credit, or maybe they're borrowing from kids who do have more money or something like that.
Yeah.
Adults age 55 and above represent 1/3 of the 195.3 million internet users, which I thought was interesting.
Mhm.
Pre-retirees feel that enjoying retirement and making sure their spouse is taken care of, I gotta fix that, is a bigger focus than leaving an inheritance. So I know that a lot of folks that age, it's a big deal to them to make sure they have some money left over as inheritance for their kids. But sometimes they're sacrificing their life today and their quality of life and everything today so they can have their time for their kids. But really the kids, I don't know. Most people think that it's more important to have a quality of life now as opposed to leaving a big inheritance for the kids. So, but there's two different takes there.
I guess it depends on their kids.
Yeah, right.
They can take care of them themselves.
Yeah, exactly.
Yeah, that's true.
Adults 55 and above are the fastest growing age group among gym members.
Oh.
I thought that was interesting. This percentage is up more than 266% since 1987. So when you go to the gym, you see the older folks there maybe a little bit.
Yeah.
I'm usually early in the morning. I'm a morning guy.
Yeah.
Maybe earlier than the older folks get there.
Right.
You're not working out in that gym you just showed me. That's
Yeah. I do, but I have to go swim laps in the pool.
Oh, okay.
I'm in triathlon.
He just showed me his home gym, and it's like you could buy a membership for that.
Yeah.
Yeah.
I've I've just gotten to triathlon recently, so I'm gotta learn how to swim. I'm trying to figure that out. So
Oh,
I'm swimming at
nice.
the gym. I don't have a pool at home yet.
Yeah, you can come use mine.
Yeah, right, yeah. So anyways, but I thought that was interesting. So maybe if you go to the gym later in the day or late morning or afternoon, you might find more of the older folks that are working out. This was interesting. The population of borrowers aged 65 and older are kind of, they're gravitating to certain areas of the country. So you'll notice maybe the western half of the United States, the darker shade is the majority, the higher population. Why do you think that is?
Climate.
Climate, it's warmer,
Quality of life.
quality of life, yeah. It's probably pretty cold up here in the Midwest, right? And the Northeast. It's pretty cold in the winter time, right?
Yeah.
So anyways, yeah, you're right. California, Nevada, Arizona, it's maybe the climate, maybe they gravitate towards these areas
And
more.
it might be less populated.
Less populated, yeah. You might be able to get a home with a larger yard or something like that.
Yeah.
All right, here are some of the challenges that seniors face today. Inflation, I just mentioned that a minute ago, like that's kind of a big deal right now, especially inflation. Like, I mean, the price of gas, I mean, everything, the price of everything.
Yeah, if they're on a fixed income, that's tough.
And, you know, a lot of these employers these days, if you're not of this age demographic and you got a job somewhere, that they're accounting for, they're increasing wages and whatnot to account for inflation. But some of these seniors, they're living on Social Security or maybe a pension, and they're not going up.
Right.
So
your buying power goes down.
your buying power goes down. But we're going to talk about buying power. This is the reason for this class. So it's not all doom and gloom. We're going to have a solution for the senior community, which is reverse mortgages. All right, medical expenses is also an issue. Like medical expenses, when you get to be older in age, medical expenses seem to go up, right? Maybe investments are not performing. They have all this money invested in these different things, and maybe the stock market's not doing too well, or whatever the case is. The investments aren't performing. This is definitely a challenge. They're outliving their retirement plan.
Yeah.
So maybe they have a
You
401k.
lived too long.
You live too long, yeah. Maybe you're a 401k or it's
No,
not-
they just didn't invest enough. They
Yeah,
lived the right time.
yeah. Social Security.
That's our job. Help them.
So we have Social Security. How long is that going to last, right? I mean, is the money ever going to dry up? But for sure, the Social Security does not really go up at the rate of inflation, so that's an issue for them. Taxes. The one thing's for certain, taxes they don't go down. They're always going up, right? Pensions. Sometimes you get a pension that maybe it's a government-backed pension, and it's good for a long time. But there's other companies you get a pension, sometimes they go out of business and the pension is no longer there. So there's different issues there, pensions. Kids moving back home, we call them boomerang kids.
Yeah.
So,
Just keep coming back.
yeah, the kids can, and
Jeff would love to have
Yeah.
his kids and his grandkids anytime, right?
Yeah.
so the kids, the grandparents love kids coming back,
Yeah.
but when they come back, they typically don't share in the expense of coming back, right?
Yeah.
So they're
Free rent, free
eating food, yeah, they're eating the food, they're using the resources and utilities, like the water and the power bills go up, and so it's great to have them back, but it can cost more money too, and lots of times they don't have the money to do that, so. Home maintenance is an issue. I have a client who's working on a reverse mortgage right now, and the home maintenance is a huge issue. They can't walk upstairs. They can't go out and mow the lawn, and so they have to pay someone to do that.
And your
But-
houses are like 50, 60 years old, right? Or 70, so you have like plumbing issues, electric
Yes.
issues.
Exactly.
Stairs and everything.
All those
Some things are not up to code.
Yes, and things break. Yeah, exactly. So that's an issue. Okay. So what are the options? Well, they can sell their home. They probably have a ton of equity, right?
Mhm.
But then they have to go find somewhere else to live.
Yeah.
You take out a home equity loan
Mhm.
if they qualify, right? Because with home equity loans, you have to qualify with income and credit and.
A lot more structure.
Yeah, like you have to be qualified to do that.
Could be able to pay it back.
You gotta be able to pay it back, but but then if you do that, then you put your house at risk too, because if you can't make the payments, then you're in risk of foreclosure and like, it's just a higher risk move, I think. How about the reverse purchase? So this is what we're gonna talk a lot about today is reverse mortgages, how to use a reverse mortgage on a purchase transaction, and how amazing it is. It's actually an amazing product. It's one of my favorites. I've never done a reverse mortgage for somebody and felt like, this is not a good thing. Like it's always an amazing thing. And I'll tell you why. Okay, first keyword is purchase. So those of you online, this is your first keyword. There's gonna be 3 of them throughout the presentation. So the first keyword is purchase. So you have to get credit for the CE, I need to know these keywords and that you actually were listening, okay? Okay,
So question,
yes.
does it only work for the seniors or like a younger generation like us can take advantage of this product?
It's a senior thing. So you have to be 62 years and older
To qualify for the mortgage?
to qualify for a reverse mortgage. Yes.
Oh, okay, 62 or
62,
older.
yeah. As soon as you turn 62, then you are in the running. You could qualify for a reverse mortgage.
So I'm glad you brought this part up so early because I think we need to talk more about this because most people think reverse mortgage is a refinance product and not, hey, I want to get into and I've met people that weren't educated properly and they refinanced and stayed in a house that had stairs and everything. And they would have loved to have,
Yes.
bought something better equipped for them,
Totally.
but they weren't educated properly.
Yep.
Yeah.
Yep, exactly. So, we're gonna talk a lot about the purchase trend, the purchase version of a reverse mortgage to buy a home. All right, and plus, seniors today are sitting on over $6 trillion in equity. Like it's hard to quantify that number, 6 trillion. Like, what does that even mean? But most seniors, everybody has equity these days. But if you're of the senior population and you've been living in this house for 20, 30, 40 years, you probably have a ton of equity.
Most of them are paid off.
And most of them are paid off. And that's the thing with this. We've talked about all the challenges and how much income they don't get, these seniors. They're cash poor, but they're equity rich. Tons of equity. But the equity doesn't have nothing unless we can utilize it in a way that will help them. So that's why the reverse mortgage is so great. Okay. So logical answer like never before. There is no product that meets the seniors' needs like the reverse mortgage. Number one, there are no mortgage payments. Did you guys know that? There's no mortgage payments. What? So like literally
So you don't have to pay anything.
you're not paying, there's no mortgage payment for the life of the loan. So when a senior gets a mortgage, a reverse mortgage, he has that reverse mortgage in place until he dies. He can have it for 50 years if that's how long he or she lives. And there's never a mortgage payment. It's awesome. Well, I'll tell you how it works. So
There's a catch to it. He says, okay.
So no mortgage payments, no employment requirements. So typically on a regular Ford mortgage, it's a thing you have to qualify with: income, employment, assets, and credit, and everything else.
Make sure you can pay back, right?
Which you pay back, exactly. So there's no mortgage payments, there's no employment requirements, there's no asset questions.
Okay, that part I don't understand. How do you give someone mortgage without checking anyone's assets?
I'll tell you, that's a good question. I'll tell you. I got a slide for that.
I love that you haven't heard of this before.
Yeah.
This is awesome. It almost seems too good to be true.
Yeah,
It really does.
I didn't know about it too.
Yeah. And there's no credit criteria. Like, we don't care your credit score. You can have a 500 credit score. We don't care. We care that if you've had an existing mortgage for the last 12 months, then we have to make sure you've made that mortgage payment on time for at least 12 months. That's it. And because this is actually an FHA product. A reverse mortgage is a version of an FHA loan. And FHA has this thing where they need to make sure there's 12 months of no late payment history. Yeah, on a mortgage. So, but there's no credit criteria other than a 12-month history of mortgage payments. Loan to value is up to 70% based on age qualification. I'll talk about that in a minute.
How come we don't have any access to this? Wouldn't it be nice?
You will at the age of
Check.
62.
Okay.
Give it time,
In
give
40
it time.
Another 20 years.
Yeah.
So, and the biggest factor of all, and this is a big deal for the senior community, there's no health questions. And I think this age demographic, it's a huge thing, like, well, will I qualify because I'm not very healthy, you know, I'm not very healthy, I got this injury, or I got arthritis, or, you know, what I've had cancer, whatever's in your history. Like, you know, it's a big thing, like they want to get life insurance and stuff. They sometimes can't get the life insurance because they don't qualify for that. But we don't care about health. So this is a really big deal for that senior population.
Yeah.
So I'm going to back up one slide. You look at this. No mortgage payments, no employment requirement, no asset, no credit, no income requirement. Actually, there is a small income requirement. I'll tell you that in a second. And you get loan to values up to 70%. Okay.
How about if there's, sorry,
You're good.
so let's say if they don't have a, so they sold the house already. If they're renting a house in you know, those senior communities, like apartment, assisted living, not assisted living, just senior communities.
Yeah. Yeah.
So they're paying just rent,
Mhm.
not the house payment.
Like you mean like if we have to check with rent payments, the 12-month history of rent payments?
No, I
Does it-
think it
does it
only
count?
works if you have a
House,
home and
right?
equity, huh?
You can use it as a purchase product, which he'll explain. You could use it to buy a home,
Mhm.
but the product is a mortgage, so it is linked to the property. So there's no relief of payments for a renting situation, if that's what you're asking. Is that what you're asking?
No, if they want to qualify for this
Okay.
kind of
For
like
payment
a
history.
payment, like if the
Or
loan,
the rent
right?
payment would qualify as
Yeah.
a.
Oh, like how I said, you need 12 months of mortgage history?
Yeah,
Do we need 12 months of rent history?
yeah,
I
to
believe so.
qualify this kind of
Yeah, I think the mostly the FHA is concerned about mortgage payment history, that mortgage debt. That
Okay,
show up on
so
credit
so
report.
basically, if they don't have a real like an actual property, they can
How do they
qualify.
qualify for that?
No, unless they wanted to buy a property, then they're going to buy that's an actual property using the reverse mortgage to purchase it. Just like you would use a regular forward mortgage, a regular traditional mortgage, you would just use reverse mortgage instead to purchase it.
Purchase it,
To
oh,
purchase-
so but still they can use this one to purchase house.
Yes,
If they're renting, oh.
yes, absolutely.
Because I know a few people too,
Fantastic.
they're younger people.
Yeah.
Like
Well,
60
you have to be
something years old, yes,
Okay.
over 60, yeah,
Okay.
for sure.
Okay.
So,
Okay.
and then, but they sold their house a long time ago.
Yeah.
They're living at the senior communities, you know, apartment
Yeah.
condo type of thing.
Yeah.
They don't own it, but they pay payments
Yeah.
still.
Okay.
So I can present them, right?
Be like,
This
hey,
one,
we'll buy a house. Don't make
Right.
any mortgage payments.
Right.
Yes.
So
With
that's
no
what-
equity, nothing.
with
But
no
they'll have to
equity.
have, yeah, there's a calculation he'll get into
Oh,
based
so
on
maybe-
age.
No, that's maybe I'm a
and-
little ahead. sorry.
Maybe I should continue with the slides. And we can
Yeah,
answer
yeah,
these
sorry.
questions.
Yeah.
No, you're good. That's a really good question.
Okay.
Hey, that's good though. We get excited and we jump ahead, right? It's
Right.
like, no patience to let you go through your presentation.
No,
When
this
you
is
go,
good.
there's a lot of things.
Questions are good. I
Yeah,
like.
Okay, so moving forward, okay, but reverse mortgages are bad, right? And this is something that comes up with the senior community. There's a lot of negative floating around about reverse mortgages. The reverse mortgage product in general is kind of a new product. So if you compare it to like a standard traditional 30-year fixed forward mortgage, those things have been around for 100 years or more. And everybody knows that it's comfortable. It's what's always been is the regular 30-year mortgage, 30-year fixed monthly payments, until you pay it off in 30 years. That's what people in their head, that's the comfort level. A reverse mortgage, when a reverse mortgage came out, you'll see the history in a minute. It wasn't that good. It wasn't that good of a product. In fact, it was more risky. And what came along with that was kind of a bad vibe and a lot of negativity. And it's just carried on over the years. And a lot of the seniors, they remember that. And they think, well, no, reverse mortgages are bad. I don't want to do that. It's bad for me, right? But it used to be bad. And now it's not like that anymore. So we're going to talk about that. There's a lot of misconceptions. Like, for example, you don't own your home anymore. That's not the case. You own your home just like any other property you own with a mortgage on it. It's just a reverse mortgage versus a forward mortgage. The bank could foreclose on your home. Well, the bank could foreclose on your home if you had a regular mortgage too, right? And in fact, you're actually in a safer position with a reverse mortgage in regards to foreclosure. And I'll tell you about that in a minute too. only people with no other option should consider reverse mortgage. Well, maybe. I know a lot of people that use the reverse mortgage even for investment opportunities. And we'll talk about that too. Closing costs are extraordinarily high. Closing costs are slightly higher. Not gonna lie, they are a little bit higher. Not that much higher. It's basically the standard cost you see in any other mortgage. There's title fees, there's taxes, there's insurance, like there's different things that show up on a settlement statement that you see on every transaction, right? There's a few extra fees on a reverse mortgage that is specific just to reverse mortgages that maybe take it up a little bit higher, but they're not outlandish. So, but they are a little bit higher. You leave your estate with a debt when you get a HECM. Okay, I didn't say this before. The HECM, HECM, is an acronym for Home Equity Conversion Mortgage. Home equity conversion mortgage. It's basically the same thing as a reverse mortgage. So sometimes I'll say HECM, and sometimes I'll say reverse mortgage. I don't want to confuse you. It's one and the same. Okay. But this is a misconception. You leave your estate with a debt when you get a HECM. Well, you do. So there will be a debt on the home and your estate or your heirs, your children. When the borrowers pass on, if they got this reverse mortgage and then they pass away, the estate is left for their children or their heirs, right? There is a debt, just like any other mortgage, and the heirs or the children have to decide what they want to do with that home and the estate. Do they want to sell the house? Do they want to keep the house and maybe pay off the mortgage, some like a refinance or something, which they can do. But this is the case. There's a debt that's left with their heirs, but it wouldn't be any different from any other type of mortgage, right? In the dark ages, reverse mortgages were created in 1961 and sold by savings and loan and insurance companies in the 70s as annuity type products. If a senior outlived the equity in their home, the bank could call the note due, require partial payment or foreclosure on the home. This was when it first started. This was one of the negative things about it. It used to be that if for some reason the senior went upside down and there was no more equity in the home, then the bank could be like, hey, we're in a bad position now and you're upside down. I'm going to call this entire note due. You owe us all this money now. Mm-hmm. And that was the case, but not anymore. Okay, that's a misconception. If the home sold for less than the amount due to the homeowner or their estate was liable for the deficit. This is also no longer the case. It used to be if you were upside down and you sold your house, let's say you owed, you owe $400,000 on your mortgage, but the home is only worth $300,000. It's a $100,000 deficit there. Yeah. Well, with the reverse mortgage, there's an insurance that you pay for that pays for that deficit. This is the good thing about HUD and FHA took over this product. FHA insures it now so that the homeowner or their heirs or the estate, whoever's taking over the estate when they pass on, they are not liable for any deficit. So in that same scenario, if the mortgage balance is $400,000, the value of the home is $300,000. There's a $100,000 deficit. They're upside down. The insurance, the mortgage insurance that is paid for, is paying for the deficit. That $100,000.
The insurance. Is it like a PMI? And
It's
like
it's like an FHA PMI. Correct.
And then you have to pay for the life of the loan. It does. You can't drop it.
It's actually an upfront mortgage insurance premium. You pay for it upfront at closing. This is one of the fees that makes it look like the closing costs are higher.
Oh, that's higher.
Okay.
Yeah.
So it's calculated on the percentage of the price, or how does it
It's
work?
calculated on the percentage of the value of the home. So
Okay,
the home
at
is-
that time, at the
At the time of closing. At the time of closing, correct, yeah. So you're paying for this insurance policy so that the deficit, if there happens to be a deficit, then nobody is liable for that. So the homeowner or their heirs, which is nice. It's because that's what a huge concern. These older folks are like, well, what happens if the market crashes? And everybody thinks the market's going to crash. Right. What happens if the market crashes and suddenly I'm underwater by 200,000 or whatever, well, it's okay. Your mortgage insurance is going to pay for it, and nobody has to pay for the deficit. That makes sense?
So is there a regular PMI with that mortgage also?
Yeah, there's a monthly, but they don't pay for it monthly. It just gets tacked on the loan balance. They don't pay for it on a monthly basis.
Okay, but it doesn't mean it's not there, it is there.
It is there.
Okay.
Right, yeah. So I'm gonna answer all your questions here in a second, I think. Most loans include equity sharing agreements typically, let's move forward here. So another history timeline. In 1961, the first reverse mortgage funded. Reverse mortgages developed by private banks and insurance companies as annuity type programs. Repayment required if the homeowner outlived the loan agreement. And no homeowner protection against foreclosure. This is the olden days. This is no longer the case. All right, 1987 FHA reverse mortgage bill passed to allow HUD to insure reverse mortgage. This was key. This would give us all the protections. Was that when FHA stepped in? First FHA insured HECM loan funded, and then in 2008 was the first time that reverse mortgage was allowed for a purchase transaction. Okay. And then fixed rate lump sum loan option made available in 2011. So how are loan amounts calculated? Let's talk about this. This might answer a lot of your questions. We're gonna spend a little bit of time on this slide. How are loan amounts calculated and how does it work? Well, you have to be 62 years or older to qualify, right? What's happening here is the mortgage is serviced by the owner's equity. So let's say let's say you get a mortgage for $200,000, but the home is worth $400,000. That's 50% loan to value, right? There's no mortgage payments, but there's still an interest rate attached to the mortgage, right? What you're thinking, yeah, if there's an interest rate, how there's no mortgage payment, how it happens here? So the interest that's typically paid on a monthly basis on a traditional mortgage, that interest instead is tacked on the loan balance. So in effect, over time, the loan balance is increasing. It's continually going up and up because that's how we service the loan on a reverse mortgage is the homeowner's equity. So if you start at $200,000 on your loan balance in the beginning, 10 years later, that balance might be $260,000 or $270,000 because we're using the equity to service that loan. The interest is being tacked on the loan balance over time. Does that make sense? Okay. So that's why the age of the borrower is important because if you're 62, we have to expect you're going to live to be 100 years old or longer. So the loan to value, you might be limited at like 45 or 50% loan to value if you're 62 years old. But if you get a reverse mortgage and you're like 85 or 90, then you're maybe like 75% loan to value or higher because your life expectancy is as long as a 62-year-old. There's not enough. Does that make sense? Yeah. We don't need as much time for interest build up on your loan balance. So the principal limit is based on, so the beginning principal limit, how much loan you can qualify for is based on your age and whatever the interest rate is when we close, okay? And then of course the lowest of appraised value or sales price. So, okay, I wanna make sure we're on the same page. Does that make sense? Are we good? Did I confuse you at all?
So basically, the reason there's no mortgage payments doesn't mean that the mortgage company is not collecting interest. They're just not collecting it from you as the homeowner. They're adding it to the loan balance because they only loaned you a certain amount of the equity, preserving the additional equity for the increased interest to be tacked onto the loan. So the balance will go up. So so that brings up a question. Is there a specific calculation based on age and expectancy that somebody could kind of figure out? Is that like an equation or is it more of an algorithm?
It's an algorithm. Well, I would say algorithm because it also interest rates, current rates have an effect on that same equation. So if your rates are like 2%, then we can get a higher loan to value because interest won't be added on as opposed to maybe as a 5% rate, then it will go up higher. So if you have somebody that you're thinking of, just say, hey, I got somebody, he's 65 years old, and I just need to know how much of a down payment is he gonna need, because we're looking to get a reverse mortgage for this guy on this purchase transaction. So yeah, I would just give you a call and I could just do the calculation. I've got some software and I look at the interest rates and then we say, okay, he's 65, he's good at 53% loan to value. He needs at 47% down payment. And then he can buy this home never have a mortgage payment.
Okay.
And move on, and he's got that loan for the rest of his life.
So that down payment would have to come from, maybe they sold a previous residence and they had a bunch of equity and now they can go move into a different property and they've got all this equity to work with on the one they sold, right? Or maybe they have other retirement, like some of your friends that are renting, maybe they've got a retirement account or something that could be used now as a down payment for a house and eliminate their monthly expense of having a mortgage payment. Might be a better use than a 401k or their stock portfolio that's diminishing,
Right.
something like that. So the equity has to come from somewhere. So like in a reverse mortgage refinance, they've lived there for a while, they've probably got a lot of equity, and so the home's already there if they're staying.
Yeah.
But what a lot of people don't understand, and I think we need to talk about more, is the purchase aspect. It's like, I don't want to be stuck in this house forever, I'm not gonna do a reverse mortgage. But if they sold that house and took that equity and put it into another product, based on his example, maybe they have $500,000 equity, right? They only need to put $200,000 down to get a $200,000 mortgage, and they still retain some of their capital and liquidity for whatever they want, vacations and lifestyle, but they could still get a mortgage depending on how much equity and assets they're working with to make that next purchase, right?
Yep, perfect. Thank you. You want to teach that?
So-
You can teach.
Yeah, we can tag team it.
Yeah.
I love this product.
Yeah.
Unfortunately, it was before I met you, but I helped my mom, and it took years for her to understand that this was going to change her lifestyle, and this is a good product for her because she didn't know anything, well, very little on her house, and she was making a payment. She on a fixed income, so her entire fixed income literally was going towards her mortgage payment. And the only reason she had money for food and utilities is because she rented out some of her rooms. And so by doing this, she eliminated her house payment. It's like a $1,200 a month payment that went away.
Yeah.
And it changes everything for her. I'm like, go out and blow $200 a week. You know, do something fun, get out of the house.
Oh, yes. Exactly.
Yeah, it's based on the equity and that equation. So the older they are, the more they're gonna have access to and more choices and options. The younger they are, maybe it doesn't make sense. You know, watch the interest rates. Maybe when the interest rates come down, values go up. Maybe I'll do one on 70.
Right.
Depends on where they're at. If they just, it might make sense too financially if they're 62, 63, and they don't see any change in their future for their income.
Yeah.
So if you have no equity and no existing home, and you were renting and you're purchasing something with the reverse mortgage, for the lenders, they are hoping to get that money back when they die, and they can get that money out of the equity. Like, how does it work? Like,
They're still gonna have to have a down payment. That's what I was just explaining to Tony, is the loan to value is going to be based on their age and the interest rate and how much time they have left to sell. So they're not loaning 100% on the purchase. They're gonna loan anywhere.
How much is the down payment then?
Depends on their age, but like if they're younger, like maybe 62 or 65 years old, you're probably looking at a 50% down payment. 50%.
So if you have no money, this is not an option for you at
If
all.
you don't have any money, then it won't work.
Yeah.
It really works if you have an existing, we're gonna talk about.
If you're old and rich.
Well, equity or retirement
Retirement
fund
funds,
somewhere.
you can pull from somewhere else.
But you said you don't ask any asset questions, right?
We only ask, we just need to know where the down payment's coming from.
Not to
That's an
qualify
asset.
to make a payment because there's no payment. So the
Yeah.
only asset question is, we're only gonna loan you 60% of the value of the home. Where are you coming up with the other 40%?
Yeah.
Okay.
Okay, there's several examples I'm gonna go over.
Okay.
And you might have some light bulbs of how you could use this for your clients. And it's actually really amazing and what we could do, especially for you guys as real estate agents, and how you can help your clients. So, so the younger the borrower, the lower the LTV.
Want to value.
Yes, the lower the loan to value. So the younger, like I said, if you're 80 years old, then you're gonna probably have 75% loan to value, 25% down payment. But if you're 62, you're probably gonna have 50% down payment, because you have to account for a whole lot of years remaining in their life expectancy for that interest build up on that loan balance. Okay, so moving forward. Like I said, you need to account for more years of mortgage servicing with the equity. Now, obviously, we all expect homes and values to appreciate, and most likely over the next 20, 30 years, values will go up. And And I don't think they're accounting for that. So most likely you're not going to be upside down. You know, when you pass away, there's going to be plenty of equity to leave for your heirs and your estate. So, all right. So what about repayments? Let's talk about that. Now, like I said, there's no monthly payments. The loan does not need to be repaid until all borrowers die or leave the property. Okay. Now, all borrowers meaning, you know, let's say you have a husband and wife. Let's say the husband's 5 years older than the wife. Husband passes away first. That's okay. The wife remains, and the loan is still in place. No mortgage payments required until the wife passes away. So both borrowers have to pass on before any repayment.
So both of them has to be on the loan name or.
That used to be the case, but no longer.
Oh, no.
You can now
So if
have,
I borrow it, I don't have to involve.
Yeah, but once
any-
you die, it's due.
actually,
Right.
that used to be the case.
Yeah.
But they've got some protections now for, because you might have somebody who, you know, when you close on your purchase, you might have somebody who's 62.
Mhm.
And then the spouse,
Mhm.
husband or wife, might be 59.
Mhm.
Well, the 59-year-old doesn't qualify for because he's not 62 yet, right?
Mhm.
So the 62-year-old is the only one on the mortgage,
Mhm.
but there's protections for that 59-year-old.
Okay.
And so, so if the 62-year-old does pass away first, and the loan's only in his name, the loan can stay in force until the 59-year-old passes away too. Even though she's not on the loan, there's protections for that 59-year-old. That's a recent change. Even just a few years ago, that wasn't the case.
Mm.
It's
That's awesome.
it's a new.
So in most cases, you'd want the husband and wife on there so
Right,
that
right.
the surviving spouse can retain
Right.
the property.
Mhm.
Because she won't have to move.
Yeah.
She lives 50 more years.
Yeah. Okay, the loan can be repaid through the sale of a property or other assets such as proceeds from life insurance policy or loan refinance or whatnot. So what happens is when both borrowers or, you know, husband and wife both pass on,
Okay.
then you have this home and a mortgage, and that's when full repayment is due. And typically what happens is that mortgage or that home is passed on to the heirs or children or whoever's taking over that estate, right? So the children have, I think, 6 months to 12 months to take care of that mortgage. Nobody's having to make payments, nobody's servicing the loan. It's really just, they say, okay, you got about a year and we just gotta have this paid. You can either refinance it. If you guys want to keep the home, that's great. Figure out a way to refinance it. If you want to sell it, awesome, put it on the market, sell it. Either way, it just needs to be paid for.
Mhm.
And whatever equity is remaining, then that equity goes to the estate, to the children
Yeah.
as an inheritance.
Mhm.
So.
And if it doesn't get paid, you can foreclose on it.
If it never gets paid, then they probably will foreclose. Now, these mortgage servicers are not in the business of foreclosures. Like, they don't want to foreclose. They want the estate to be handled by the heirs, by the children. And let's say in the off chance they're trying to sell the home and it's not selling. Like, you know, it's been on the market for 6 months and you can't sell this
But you
thing.
work.
But you just talk to the servicer, hey, we're trying, it's not working. They're gonna give you time, they're gonna be forgiving, they're not some, you know, they're not the police trying to take this home away from you. They want to work with you. But what's bad is if the children are silent and they don't communicate at all to the servicer, then the servicer doesn't know what's going on. Well, I don't know what's going on. We have to get it paid for somehow. If they're not taking care of it, then we're gonna foreclose.
Right.
But if there's a communication there, then they'll work with you as long as you need. So. All right. No debt is passed along to the heirs and there's no personal liability. So, you know, even though there's a mortgage, just like any other mortgage, it's just nothing passed on to the children. Once the loan is repaid, any remaining equity belongs to the homeowners and or their heirs. So we mentioned that. Okay, so today's HECM loans, they're insured by HUD. The homeowner will not lose their home regardless of the amount owed or the relative value of the home, as long as taxes and insurance are paid. So here's the thing. Like I said, there's no risk of foreclosure with a reverse mortgage. There's no monthly payments, like, you know, if you don't make a payment, you know how it is normally, you don't make a payment, you're foreclosed, right? Well, there's no payments due. The only way a homeowner can foreclose when having a reverse mortgage is if they don't pay their taxes or their insurance. And it's not gonna be the servicer that forecloses, it's gonna be the county that comes out and says, hey, we're gonna repossess this home because you're not paying your property taxes.
Yeah.
So you gotta make sure the taxes are paid, insurance is paid, and if HOAs do, you gotta pay the HOA fee. And it's these small amounts of monthly payments that we have, this is the reason why I have to verify a little bit of income, which is typically never an issue. We just need to verify even social security is enough to verify that, hey, these guys have enough money to take care of property taxes, homeowner insurance, HOA. If there happens to be other debts on their credit, then we have to make sure that they can pay for those as well. So, but I've never had that happen where it's an issue where someone can't qualify because they don't have enough income.
But for the taxes and insurance, is it true that you can also set up an escrow account where they retain part of that loan amount to make those payments
Yeah,
for them?
so yeah, taxes, insurance, you can pay those in any way. Typically, I mean, traditionally, it's an escrow account, right? You pay on a monthly basis. Well, there's no escrow account set up with a reverse mortgage, but you can set up a monthly installment plan with the county to pay property taxes if you want. You can pay monthly with taxes, even if there's not an escrow account set up with a mortgage. Does that make sense? The same thing with homeowners insurance. You can do a monthly payment plan with insurance and all that. So there's ways that these seniors can work through this. Okay. All right. No mortgage payment can ever be required. Only property taxes and homeowner insurance must be paid. The homeowner retains any equity over the amount required to pay off the loan. We've already talked about this. The homeowner or their estate are not liable for any deficit owed on the mortgage at the time of sale. So here's how realtors can benefit. Okay. Retiring renters are choosing to maintain a comfortable lifestyle in a home that better fits their needs. This opens up a huge market of potential clients who could benefit from them selling their current home and purchasing another for retirement. This can help you produce more sales. We're going to talk about these in examples. Increase your listings, increase buyers' purchase power, and market to 55+ communities. So let's say you have somebody, let's say you have a client who they need another home. It doesn't work for them. They're seniors that has way too many stairs. They need a new home, low maintenance, whatever. Well, you list their home and then they use the proceeds of that home to buy another home using reverse mortgage. And we're going to talk about how that's actually an amazing way to set it up when buying a home. You're increasing their buying power and not increasing monthly payments. I'll show you in a minute. So here's a traditional home. You own your home. There's no age restriction. Okay, this is a regular traditional forward mortgage that we're all used to. The bank lends you some money. You owe the bank the money you borrowed plus interest. Property taxes, insurance, maintenance must be paid. These are all things we already know. Okay. You pay the bank back using your income or other assets. Okay, this is a traditional mortgage. Liquidity decreases. You're having to use your liquid assets and reserves and income to pay your mortgage. You can owe more than the home is worth. And you can owe more than the home is worth. Right. And you owe the deficit. Do you remember back in the days in 2008 when people were upside down?
Yeah, it was bad.
Yeah.
Short
So
sales.
people actually owed that money. Like,
Yeah.
even though you're upside down, doesn't mean it just goes away. Like,
Yeah.
you still owe that money even though you're upside down.
Yeah.
Risk of foreclosure if payments are not made. So that was the thing. Foreclosure's happening all the time. So here's the heck on the reverse mortgage. Same thing. You own your home. There is an age restriction. 62 years old. The bank lends you money. Same thing. You owe the bank money, you borrowed plus interest, same thing. Property tax, insurance, and maintenance must be paid, same thing, okay? You pay the bank back using your equity in your home at the end of the loan. You're not using your assets or your income, you're using your equity. Liquidity increases. So all that liquid money you had, like in your bank account and monthly income, that's increased because you're not making a monthly mortgage or mortgage payment. You'll never owe more than the home is worth. Even though the balance might be there, where if the market crashes and you might be upside down, you're not going to be like not like that deficit.
You have the insurance,
You
right?
have the insurance, yep. No payments required, no risk of foreclosure. Able to preserve retirement funds. So this is a great thing. So a lot of these seniors, they've got these retirement funds, maybe 401k, maybe IRA, they got some stocks, wherever they've invested. Well, what if they have to draw on those retirement funds and use them? But what if when they draw on them, the market happens to be really bad, and also those assets have gone down so much that like I need money now. Well, if you have a reverse mortgage, maybe you can use this and not draw on those, wait for them to go back up, right? So you have options at this point to live and maintain your lifestyle and not draw from retirement if they're not performing very well at that time. Does that make sense? So and financial planners love this, okay? All right, so we're gonna go back. I like this slide because it really shows it side by side, the differences between the traditional and HECM. Okay, so here's a quick knowledge check. There are no monthly payments and the loan does not need to be repaid unless the borrower sells the home is no longer the primary residence of at least one borrower. The borrower does not pay taxes or insurance or maintain the property, or D, all the above. What do you think the answer might be? There are no monthly payments and the loan does not need to be repaid unless. So the borrower sells the home. They're not living there anymore.
All of the above, right?
D, all the above. Nice work. You passed.
Yes.
I got a little stressful there for a second. Okay. Another one. Which of the following is false regarding home equity conversion mortgage? The loan becomes due and payable if the borrower does not meet the loan obligations such as failure to pay taxes and insurance. The borrower does not retain title with the HECM loan. The HECM is a non-recourse loan. The HECM is a government insured loan.
Is it here or just there?
Is it not on there?
Yeah. Oh, I didn't switch. Yeah, it's right here.
Oh, it's
Okay, we didn't go over this one.
Yeah, that's one wrong.
That's the
Thank
answer.
you.
Answer, that's
Is
the
it on
answer.
there?
So the first one we answered was this one, and
That's-
then
yeah,
we
That's
jumped.
the answer.
That's the answer.
All of the.
Oh, this is the answer on the bottom.
Yeah, the
Oh,
next
okay.
page.
Oh, you cheated, huh?
Yeah,
I didn't say it. No, I didn't say it. Sorry.
Oh,
Just kidding.
all right, then E, the loan does not have to be repaid to the lender until the home is sold or passed to the heir. So which one of those might be false?
B.
You cheated. So you're right, the borrower does not retain title. The HECM is a non-recourse loan, meaning there's no risk of foreclosure. They're not collecting, there's no, it's an open-ended, meaning it's only due when they die. There's no recourse there. Government insured loan, it is a government insured loan. It's insured by FHA and HUD. Anyways, we talked about all those things. Do you have any questions at this point? I feel like I've been talking a lot. Any questions I can cover that you've been thinking about? If not, that's okay.
Yeah,
Yeah.
right now.
Okay.
Amigos. You guys are-
Okay, so what happens if one spouse is younger, let's say 35? That would never happen, right? So,
It would.
yeah, so like you've got one who's 62 years old and the spouse is 35 years old.
I've seen him.
Yeah. you've seen it.
Wow.
Yeah, I mean,
That's
so
quite a story.
that does happen, and it's
Okay.
maybe not.
The only way, if the spouse is 35, is marrying to 60 something, is that person being rich, so he does not need a reverse mortgage.
Yeah.
He already has enough
So
money.
it's out of the option.
Yeah, that's right. Well, okay, yeah, so, maybe not this drastic, but it does happen, where like I mentioned earlier, it might be a 62-year-old and maybe a 59 or 55-year-old or whatever. And it used to be, not very long ago, where that 55-year-old couldn't be part of the mortgage, and then when the 60-year-old passed away, then, if this happened 20 years later, that 55-year-old is 75 years old, doesn't have a job, doesn't have any income, but they had a reverse mortgage and her, his or her spouse passed on, well, then she has to figure out where to live, because or how to figure out how to deal with that mortgage, but that's no longer the case. There are now protections, even if you happen to be 35 years old,
Wow.
there's still a protection. So the difference is we have to use the age of the youngest borrower. So remember when we talked about the calculations for loan to value and calculations and all that. So if you're older, if you're 75, 80 years old, then you can have a higher loan to value. Right. But if you're younger, then you get a lower loan to value. Well, if you're 35 years old, you get even
Better.
lower loan to value. So meaning if you're 35 years old, you might be living for another 60 or
Mhm.
70 years.
Would almost not make it worthwhile.
Your loan to value might be restricted to like 20 or 30%
Right.
loan to value. So, but they have to account for this 35-year-old living to be 100 years old and all those years, decades of interest build up on that mortgage.
Because the loan is gonna stay.
So
Yeah,
even
make
if
sure
the
that-
35 years old is not part of the mortgage, they still have to take that into.
Yeah,
consideration.
because the loan is gonna be staying with her, even
So
if the
Jeff, why
husband
would you
dies.
say it's better if the spouse is on the reverse mortgage?
Well, not in this scenario, and
Like
this
if
is kind
it-
of drastic, they
Uh-huh.
wouldn't qualify for as much, so it might not even be a product they would even do. But if they're both in their sixties or their seventies, if something happens to the one, the other one has the right already predetermined that they get to stay there as long as they live.
Right.
Without having a payment. But if it's just, say, in one spouse's name, they don't own the house, they're not on the mortgage, they don't really have any right. It would come into the situation where if somebody dies, the last person on the title dies, then they have those 12 months he was talking about, 6 to 12 months to sell the
Yeah.
house.
But then you say that person is protected.
It's protected. So here's the thing. If you have a husband and wife, they're married,
Mhm.
there's no option for either the husband or the wife to not be on the loan if they're both of the age 62 and older.
Yeah.
Like if let's say you have a husband and wife who's 65 and 66, they're
They
both
will
gonna,
be, uh-huh.
it'll be
Uh-huh.
required. They're both on a loan together. But in this scenario or circumstance where one of them happens to be younger than
Mhm.
62,
Mhm.
there's still protections for the younger. That she can't be on the loan, he or she can't be on the loan, but they're still protected with.
But she can be on the title.
She
though,
can be
right?
on the title.
Because normally a 35-year-old doesn't qualify for the reverse
Correct.
mortgage, so that's why the protection comes in.
Correct. It was a
So
big,
when she turns 62, like, is there something else goes on or?
No.
Okay.
no. I mean, she could, if she wanted to, she could refinance the existing reverse mortgage. That's a thing right now. Where you have a reverse mortgage currently, you refinance your reverse mortgage into a new reverse mortgage because suddenly you have a lot more equity and you have access to a lot more equity
Mhm.
to take some cash out.
Yeah, think about if somebody did a reverse mortgage 10 years ago,
Mhm.
their equity position's a lot different than it was when they qualified for that reverse mortgage 10 years ago. So they could do another one, refinance it, pay off the
Get some
old
cash out.
reverse mortgage.
Uh-huh.
Yeah, exactly. Yep. So that's a
So
thing.
technically, whatever your age limit is and whatever requirement for the down payment is, when you refinance, you take the difference and you just give them whatever down payment you qualify for.
That is correct.
Okay.
This was an issue, like, this is a recent development where there's protections for the younger.
Mhm.
It was an issue where, you'll have these couples, they're married, and one's 65, one's 55. And 55 couldn't be on the loan, she didn't have the protections.
Mhm.
And it was an issue because that 65-year-old passes away and suddenly this 55-year-old spouse, they're in a lot of trouble. They need to find a place to live and they can't qualify for anything. So that's why they're just continually evolving and making this product so much better and so much more safe for the seniors. It's really an awesome product. So, okay, so here's a common buyer profile who it might be appropriate for. So you're ready to downsize, upsize, or move closer to family, okay? They wish to purchase their dream home without having a required monthly mortgage payment. This is a thing. This is a really cool. I'll talk about that in a second. They can move closer to their children or maybe farther away. They don't want to live with the children, so they can go either way, right? They want to live closer or maybe farther away. It'd be great for somebody who lives on a fixed income. Maybe they want a new home that is better fit for their physical needs. Low maintenance community, increased purchasing power. We're going to talk about that in a second. They want to preserve some of the proceeds from the sale of their home for cash reserves or other retirement savings. So this is a common buyer profile of the reasons why somebody might want to use a reverse mortgage to buy a new home. Okay, for those of you online, there's several of you. The second key word is buyer, okay?
If new ones popped on after you said it first, remind me. of the
Okay.
license number.
For those of you that popped in, and weren't here for the very, very beginning, there are several keywords throughout. So we can get you the credit for the CE. This is the second one, which is buyer. Again, I need your name and your email address and your license number to get you the credit for the CE. It's a 2-hour CE credit. And then I just need to make sure you're engaged and listening. So I need you to tell me what these keywords are. So the second one is buyer. Okay. And this is not my requirement, this is the state requirement, sorry, this is what the state's having to get, so. All right, moving on, here's the process. Review options and schedule counseling. Okay, counseling, I haven't talked about this yet. Counseling is a big deal. So there are licensed reverse mortgage counselors, and it's required. If you want to get a reverse mortgage, you have to talk to a reverse mortgage counselor. Once you talk to the counselor, you are given a counseling certificate.
Okay.
With that certificate, that allows me as the loan officer to move forward. Like we can't get we can't submit to underwriting, we can't do anything until we have a counseling certificate, which I really love because these reverse mortgage counselors that you're required to talk to and get a certificate from to actually move forward with this product. They're a neutral third party. They have no interest. They don't care about what you're doing. They just wanted to make sure that you know what a reverse mortgage is. And they're going to completely educate you and make sure that you understand what this is, what's required, what you have to do. And I love that because it cuts down on my time. I don't have to do the education, and I feel good about their situation, their knowledge of the product.
Because they're educated.
They're educated,
willing
exactly.
to do it.
So, yeah, so that's the very, very first step. If you have somebody, then you gotta talk to a counselor. If you wanna know where to go to get counseling, just let me know. I've got a few on my short list that are quick. They'll respond. Some counselors don't respond. Some counselors do. I have some that do respond. But you have to kind of get an appointment, like there's like 2 or 3 weeks out. So you have to kind of get that scheduled. So after counseling is done, application is made and documents provided. So we don't need very many documents. We just need to see, income verification, social security verification, whatever, date of birth. It's not very many, not very much documentation, but we do need some. Appraisal is a big deal. Obviously, we order an appraisal. It's an FHA appraisal, which also means, along with every other FHA appraisal, the house has to be in a certain condition, a minimum standard condition the home is in. So if there's safety hazards and whatnot, then they need to be fixed before we close.
Okay. Besides safety, how about all the codes? Like some customers, the like electrical, right? So changes throughout the years, and the codes are different, stuff like that. So do you see that or
no? It's like any other FHA appraisal that you see in a standard transaction. They're just going to look at the basics and needs to be a certain level of
Habitability.
Yeah.
livability.
yeah.
It's more condition. I've done several, and they're not requiring them to bring it up to today's standards because
Right.
things have changed.
Gotcha.
I mean, literally, it could even be like windows, right?
Yeah.
So if FHA will guarantee it because it's a sound house, then it would qualify. They're not saying, hey, we don't use that kind of wiring anymore.
Yeah.
Aluminum was in the 60s, man.
Yeah.
But as long as it's safe.
Yeah.
Okay.
Exactly.
Okay.
Yep. So we'll get the appraisal done. It's the same turn time like any other appraisal that you're used to. A week, maybe a week and a half, 2 weeks, depending. Right now, appraisals I think are quicker or less busy.
Yeah.
And then of course a title report, just like any other title report we need for any mortgage or any transaction. Okay. The file is underwritten, closed, the request initial funds dispersed. Like it's not, it's actually a quicker, easier process than a regular standard mortgage. Not as many things to qualify, with income and whatnot. So if there's a condominium and there's HOA requirements, then just like any other FHA loan, the condos have to be FHA approved and all that. So 2.5 weeks is standard. I recommend maybe a little bit longer on a contract if possible. Sometimes a second appraisal is required on a reverse mortgage. Not all the time. I'd say maybe 40 or 50% of the time we have to get 2 appraisals. Why? It's just because the value is everything.
And then you go with the lowest, right?
Yes.
Okay.
Yeah. So, but yeah, a second appraisal oftentimes is needed, depending on how the first appraisal goes and how it's viewed. So sometimes the underwriter will be like, okay, because of these things, we're gonna need a second report, and then we'll order a second appraisal. So.
But they can't influence the second.
No, they don't see either report. The second appraiser doesn't see the first report that was done. It's totally independent. But because of that, I'd recommend if you're writing a contract on a reverse mortgage transaction, then I would maybe try to err towards a 30-day contract instead of a 2-week contract. because we might need more time for an appraisal, just a second appraisal, if that makes sense. Okay, a senior can purchase a new home, not pay cash, the entire price, and never have a payment. This is the amazing thing about it. So we've talked about these, you can downsize, you can maybe get a second home, obtain a reverse mortgage on an existing house, use the proceeds to buy a second home and keep other investment assets intact. Or maybe they want to refinance and take cash out on their existing home right now, using a reverse mortgage and buy a rental property and create even more cash flow on a rental property. So a lot of ideas for you as the real estate agent. Multiple, so here's some qualified buyers on this subject. If the borrowers are retaining their current residence, they must document they have sufficient income. So basically, if you're gonna retain your existing home and not sell it and go move and buy another house, and the new house you're gonna buy is a reverse mortgage, then whatever expenses remain on your existing home that you're leaving, you're exiting, but keeping, whatever expenses remain there, like a mortgage or, you know, taxes, HOA, we have to make sure there's income enough to handle those expenses. So
there would be a liability.
so yeah, so we got to make sure that you can qualify with income for all the expenses, including other homes you might own. But you can still buy a new home as your primary residence using reverse mortgage. If they have other properties, we got to make sure income to service those. Okay. So
Question,
yeah.
what if you keeping this home and then using the equity to, well, you can't really use this home's equity to do the reverse mortgage on this property, huh? If you're keeping the first one.
Right. Yeah. Reverse mortgage is only good for a primary residence. You can't do a reverse mortgage on an investment property or a second home purchase. It has to be a primary residence.
Yeah, but if you move into the second home, this is your primary residence and this will be your investment property, right?
Yeah, if you're retaining your existing home
Uh-huh,
and moving to another one, if it makes sense that the new one is going to be a primary residence,
uh-huh.
then you can retain it and you can use reverse mortgage on the new home because it's going to be primary.
And you still have to put the down payment, the loan to value
All
ratio.
that. If you're using, yes,
Mhm.
yeah, exactly.
And then when they calculate everything, they will take your first home into consideration, how much expenses you.
That's correct. Yep. So borrowers are ineligible, like I mentioned a while ago, if you're in default on a current mortgage on another property, or if you've been late on any kind of mortgage in the last 12 months, then you don't qualify. So, like I said, we just need the income to verify debt ratios to make sure that you can handle whatever liabilities or expenses you have on any properties or any debt you currently have. So, all right, eligible and ineligible properties. So existing single family homes are eligible. Manufactured homes, as long as after 1976. Does that ever come up with you guys? Have you ever purchased or been involved in a transaction with a manufactured home that was built prior to 1976? I don't even, I mean, this always is an asterisk whenever I bring a manufacturer on every single thing.
Yeah, like,
Always
do they
comes
use
out.
Manufactured home in 1976, prior to that, who's gonna do that anyways, right? So anyways, FHA approved condos. Hey, oh, this is Stacy. She's from my office. She's bringing
Hi,
sandwiches.
Stacy.
Do you want to just put it on the table right there? Yeah. FHA approved condos. Keyword FHA approved. If it's not FHA approved, then we can't do it.
Has to be a good check.
Correct. New construction, you gotta have a certificate of occupancy, before, obviously before we can close and start working on everything, so. But you can do, new construction homes. So it's ineligible, we can do multifamily properties, duplexes, fourplexes, whatever. Even if it's an owner occupied duplex, we can't do a reverse mortgage on it. Condos, or manufactured homes not approved FHA. That's not eligible. Okay, so here I'm gonna go over several examples. This is my favorite part because we're talking about real life examples, things that I've run into, some of my current clients and whatnot. Let's say the purchase price is $600,000. Okay, senior's home has already sold, and he has proceeds of $375,000. So he sold his house, walks away $375,000 in cash. He wants to buy another house for 600,000. Reverse mortgage loan amount based on age, he qualifies for a $300,000 mortgage towards his $600,000 purchase. What do we do? So the senior takes a reverse mortgage on their new purchase and uses the leftover cash from previous home for leftover cash from previous home for other needs, like, and this is what the math looks like. So purchase price $300,000 reverse mortgage, $300,000 cash for down payment, and then you have $75,000 left.
You're probably gonna pay your closing costs with your 75,000
$75,000.
and with nothing left.
Yeah, no, it would be nice if I could charge $75,000 in closing costs. So the senior gets the home they want with no mortgage payments, and they have spending money left over. So no mortgage payments, they get the new home for $600,000, and they have additional $75,000 in cash. Okay, let's go to another one. Oh, seniors may want their financial planner. So yeah, planners love this because, you know, they have typically a lot of extra liquidity, monthly, you know, income, and maybe lump sum cash they can use for investing and whatnot. Here's another example. Senior loves the existing home, but doesn't want to move. Okay. Owns the property free and clear for 1.1 million. This is a normal thing. You know, look at all the older folks in Draper.
Oh, yeah.
And they've lived there my parents lived there. I grew up in Draper, and they've had their home for 40 years. They don't owe anything up. It's worth $1 million, you know? It's not like over by, you know, Hidden Valley Golf Course,
Right.
but it's like, you know, it's a nice neighborhood in Draper. But so they own the property free and clear, and then it's worth 1.1 million, okay? Senior doesn't have a lot of income. Social Security and small pension, that's it, okay? They're cash poor and equity rich. They qualify for a reverse mortgage finance in the amount of $660,000, and they opt for the lump sum payout at closing. So they take a reverse mortgage on their existing home for $660,000. They get $660,000 in cash on a reverse mortgage, never making a mortgage payment for the rest of their lives. But if they get the cash, what are they going to do with that cash?
Buy rentals.
Buy an investment property. pay cash for an investment property. Suddenly you own two assets,
Yeah.
two homes, and you're getting a rental income. You can make more money. Quality of life goes up. Or maybe they want to buy a vacation home in cash in St. George, a place to go during the winter time.
Smart investing, huh?
So
Mhm.
this is a real
I
thing.
love that. Gives
Yeah.
them options that they wouldn't think of on their own.
Nobody
Start
does.
having these conversations.
Like
Exactly.
sitting on the dead equity, you're doing nothing versus you're taking something and
Exactly.
investing in something.
Exactly.
Well, and even bringing up this example is good, because if they got the $660,000 and nobody coached them on what to do with that to make even more money, they might do vacations, their kids might say,
Might go,
oh,
yeah.
you know, and then it's just gone.
Yeah.
But if they do something with it, now they had a free and clear house. I love your example. Just take that, and even if you just bought cash for a rental property and rent it out, now they got another income source
Just cash flow.
coming in, and another asset going up in value.
Yes.
Exactly.
Instead of 2,000 a month, the fixed income, it's just
Maybe it goes up
three,
to 3,000 or 4,000.
4,000.
Yeah.
I can't wait to turn 62.
Okay, so this is a really
You're
cool
gonna be too
example.
rich by 62 to care.
I don't need a reverse mortgage.
You don't
So this is a real life example, and this is, you know, what people, you can open their eyes. You talk to these clients, this age demographic, and they're like, I don't want to move. Well, maybe you don't move, but we got this huge asset. Let's use it. Buy something awesome. Let's go buy a vacation home in St. George, or, you know, up in Park, you know, maybe not Park City, it costs more than $660,000, but you know, there's, or whatever, investment property. So the senior increases real estate portfolio without increasing monthly debt, and quality of life increases. That's exciting stuff for them. Okay. All right, here's another example. And this is when I talk about increasing buying power, okay? Senior needs a different home, okay? Too many stairs, physical limitations, yard care, whatever. And maybe they want to get closer to children. Maybe all the, you know, maybe they live in, maybe all the kids live, you know, up in Kaysville, and they live down in Lehigh or something like that. They just got to come together, right? So they got to bring them closer kids, they, different house, no stairs, all that. So this is a real life example. Existing homes value is 550,000 and it's free and clear.
Mhm.
Okay. The problem, the new home will be more expensive than the sale of existing home. You can't buy a new home what they're looking for in this market for 550,000. They need to spend more money, right? Probably like $87,000–800,000 for a new home that they're looking for. So here's the math.
Mhm.
Proceeds from existing home, let's say they get $540,000 for the proceeds of the home they're gonna sell.
Mhm.
The new home that they wanna buy, it's perfect for them, closer to the kids, no stairs, no yard, all this, $850,000. They qualify for a reverse mortgage on a new home of $470,000.
Right.
So the down payment is $380,000, but they had $540,000.
Yeah.
So then they have another $160,000 left over to do what they want. They can invest, you know, if they have the income, they can still qualify for another regular mortgage and buy an investment property or a second home or something, or they travel, you know, maybe they go to Hawaii, maybe they, I don't know, lots of things they could do, quality of life. But they have 160 grand left over. See, but they just purchased a new home, more expensive, with money left over, all without increasing monthly payment obligations.
That's so awesome.
That's awesome, yeah. They bought an $850,000 house, no mortgage payments ever till they pass away. Plus they get 160 grand to do what they need to.
Yeah.
It's an amazing product.
Oh, it is.
This is how you increase buying power. This is how you have people realize what they can do. So this is or an example of just a refinance version, not a home purchase, but I wanted to bring it up. This is an actual client that I have right now. We're closing next week on it. Senior, he already has a mortgage. It's $250,000. The home's worth $650,000. Very little income, $3,500 a month in income, that's Social Security and pension. But his mortgage and other payment obligations, like all his other debt and everything else, is $2,800 a month. But he only gets $3,500 a month in income.
Mhm.
So he has $700 a month to pay for everything.
Mhm.
And his quality of life is horrible. Like they sit at home all day. They can't afford to do anything.
Yeah.
They're using family and credit cards to pay for other stuff when they need to. Anyways, we're refinancing their existing mortgage. They're getting a reverse mortgage for $350,000. We're going to pay off their $250,000 home. Going to give them an extra. We're going to pay off all their debt, including their existing mortgage, and then they get an extra $50,000 in cash. So they're going to go from $2,800 a month in expenses to zero, plus $50,000 in their bank account. So that's huge, life changing. All because they have this home with tons of equity, and before this, they're like, oh, we can't do anything to it. It's our biggest asset. We need it. It's what we have to give to our children. It's what we can't do it. Well, I showed them this and like, wait a minute, I can save this money. I can get extra cash. So I'm completely changing their entire life. And they're
Cost
so
of
grateful.
$2,800 that they get in, now they can use it for whatever they want to,
They
right?
can travel, they can see their kids when they want, they can go to dinner, go out to eat,
So
Like,
really, they're adding the $2,800 because they're going from the difference to $700 is all they had. Now they got the full 35.
exactly,
Yeah.
yeah.
That's awesome.
And plus cash.
Plus
Plus
cash.
some cash.
Yeah. So I know you guys might have maybe other people in your life that are of the senior age, that maybe this is very common. So think about it. If you have anybody that you feel like you could be, a really good resource, and just let them know, hey, this might be a good product for you. We'd be happy to help you. So maybe it will be a good thing for them.
Yeah. I mean, it's great. It doesn't so bad when you get old. I was kind of depressed about it, so
Yeah, I know.
it's so bad now.
Yeah, you're right.
Yeah.
So
yeah.
question, why would the younger generation wouldn't qualify for this if they are sitting on really large equity too?
It's just a product they made just for the senior community.
To make their life better?
Yeah,
Because, okay.
that's where the need is.
Mhm.
Maybe someday they'll come out with a product for the younger folks. If you have tons of equity, or it makes sense.
Most younger people are still working though, and
Yeah.
so they
Yeah.
could just go do a regular refinance and make the payments and invest it or do whatever they want with it. I think this is more for the non-working class,
Right.
retirement age,
Yeah.
More like a
because
saver
fixed income.
almost.
Yeah.
And we still want the younger generation working.
Yeah, yeah.
Give
We don't
them
wanna
the
give them
pressure.
any more.
No,
excuses.
exactly, yeah. Enabling them,
Another good thing I was just thinking about too is that most people that don't know about this, they think, well, I would really love to be another house, but I have this $500,000 house myself. All I can do is go buy another $500,000 house, about the same thing as I already have.
Uh-huh.
But the way he's explaining it, now they could use a portion of that as a down payment and go to that 850 or even up to $1 million on a
Yeah.
50-50
Totally.
type of a thing. And
No
completely
mortgage
change
payment.
their lifestyle and still have no
Payments.
payment.
Yeah, it's amazing.
It
Yeah.
really is. And I'll just bring up one example too that my mom brought up is she was in that group that wants to leave something to her kids, even though we argue with her all the time. It's
Yeah.
like, I don't want nothing. I want you to live better. da, 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 da.
Yeah.
I'm not even in that conversation. She's got other kids that she thinks she wants to help. I was like, no, they need to help themselves, right? So she was like, well, if my balance just keeps going up and up and up and up, because I'm not making this payment, the interest, it's gonna erode all my equity, there'll be nothing left over to give. Well, the interesting thing is,
Shows nothing to anyone.
she owes nothing to anyone.
Uh-huh.
But when we showed her, hey, you're gonna take out this loan to value, let's just say 5%, and home prices are going up 5%, you're still potentially preserving the equity you already have because your balance is going up 5% on what you're not paying, but the whole property value is going up 5% maybe a year.
Yeah.
And so your balance is chasing your future equity.
Yeah.
Right.
And so in this day and age, take 09 through 2012 out of the equation. I bet hardly anybody ever passes on a property or when they pass on is underwater. Because we've had enough appreciation, even on the historical average, to keep up with what they're paying.
Yeah.
And so I think it's just a genius, beautiful product.
Yeah.
And even if another 08 does happen, the heirs don't have to worry about it. The siblings aren't gonna inherit that
Yeah.
debt. It's got mortgage insurance on it for a reason. Otherwise, if they didn't have mortgage insurance, nobody would make a loan like this.
Right. Yep, exactly.
So a lot of good
It's kind of
scenarios.
sad in a way to think like most people feel obligated that you have to leave something to your kids.
Why?
Like, I always tell my mom, like, I don't need anything from you. You just leave a quality of life. You can use all of your money. I'm not.
That's probably a generational
anything
thing
from
because
you.
of maybe they didn't have from their parents any
Mhm.
leg up or any help or whatever, so they want to personally provide that to a sibling, but I don't know, it's just education.
I think
it's
so, that is.
relationships and all that stuff.
Exactly. Yep. Okay, so what else we need to know? And this is specific for, these are all for a specific purchase transaction. When you do reverse mortgage financing on a purchase transaction, there are no seller concessions, seller takebacks, seller financing, or seller anything. So it's one of those things with reverse mortgages on a contract, they just don't want to see seller paid anything.
Closing costs
Closing
and
costs.
nothing.
Now, in this market, rare that we have seller concessions, right, on the contract. Sellers usually are not giving up very much to the buyers,
No,
but
Not
they're
anymore.
coming back slowly.
Yeah.
slowly.
Yeah, turning.
I've been
So-
asking for closing costs to lower the interest rate,
To buy down the rate.
to buy it down the rate. And
Yeah.
it's working,
Nice.
yeah.
So anyways, on a contract, when using reverse mortgage financing on a purchase contract, you can't have any seller concessions. So
Is there a reason why you don't wanna see?
that's a good question. I don't exactly know the reason why. It's just a product, a weird product guideline that I should look in and know the reasons why, but that's just what the rules are.
It just keeps it cleaner. Sometimes lenders think with the seller care, it's like gonna be additional debt or they're gonna, it's just cleaner. If there's no other obligations created.
Yeah.
In the transaction, it's like, here's your down payment, here's what we're on, cut and dry, and there's no other things that underwriters don't understand on how it
Right.
comes into the mix. I think it's just
Yeah.
for that
I
reason.
agree, yeah. The property must meet FHA property standards, we talked about that. Repairs, if any, must be done by seller before closing, so none of this, you can't have a fixer upper and you're doing a buying reverse mortgage, so it's pretty standard. If there's, if there's repairs, typically you want the seller to do it before closing. Sometimes it's negotiated instead of the repairs, there's like, seller concessions or lower the purchase price or whatever.
Initially completed before.
They're just, if there's repairs, it's required to be done before closing by the seller. And like any other transaction, the buyer must occupy the property within 60 days as their primary residence. That's the same with any mortgage. Seniors must maintain the property, must pay real estate taxes and ownership. We talked about that, HOA, condo fees, that sort of thing. They gotta maintain those expenses.
Buyer and seller cannot. be
Yeah, this is
related.
interesting. Buyer and seller cannot be related. So you can't have that. So they have to be unrelated.
So what's the reason?
I
Do you
don't,
think they will drive the price up?
yeah, there's probably maybe more tampering with price, and whatnot.
But then
Still
you,
needs an appraisal.
yeah,
Yeah.
2 times, not even once.
Yeah, I think.
Yeah.
Well, if they need to.
Yeah, it's not always two appraisals, but sometimes, yeah. But that's the thing too. One of those interesting things with the reverse mortgage or the purchase transaction. All right, here's the last keyword for those of you online. Reverse, that is the last keyword, reverse. Okay. All right.
So are they supposed to be putting this in the chat
Yeah, you could just
or email it to you?
yeah, why don't you email it to me? You got my email at the beginning, the first slide. I'll go back there in a second. Be the ultimate research. So don't forget to tell about the refinance version, like I mentioned, if you know someone that might benefit from that. Remember, 6 trillion in equity, can be a large source of income for them. You don't have to take a lump sum. A lot of seniors will be like, okay, I'll do reverse mortgage. I'm just going to take out $2,000 of equity a month. It's going to be like an income for me, which you totally can do. And it doesn't need to be a fixed amount. You could be like, I'm going to take 5,000 this month. I'm going to take 500 this month. You can just pull from your equity whenever you want and use it as an income for the rest of their lives if they want to do it that way.
Okay, let me give an example of it so you can explain it better, make sure I understand it right, because my mom did this and there's a
Okay.
couple of unique things that we had to do.
Okay.
So she only pulled out $20,000, but she had more available to her based on the refinance to pull out.
Mhm.
So the amount that she pulled out is part of the balance of the loan. And she's, the interest is going on, but the amount that she's eligible for that she didn't take is earning interest. Right?
It earns interest?
Because she hasn't pulled it out.
Okay, yeah.
So I don't know the exact numbers, let's say it's $200,000. She only pulled out $20,000
Okay.
that she doesn't have to make a payment on. So even though she was eligible to pull out a certain amount, she didn't pull it all out.
Yeah.
So because it wasn't given to her, instead of interest accruing on the balance, interest is also accruing on her available balance. So her available balance is going up at the same rate as the debt is going up on what she already took out. So that was another thing that kind of like washed things out a little bit for her, because if they pull out a lump sum of cash of hundreds of thousands of dollars and they don't have somebody like you to help them go invest it, what are they gonna do with it? It's going down in value every month.
Right.
Inflation's gonna just eat it up.
Yeah.
So if they don't have an immediate need for it, don't take it.
So remember how I talked about if their investments aren't performing? Let's say your stock market's down and all your investments are really bad right now. Don't pull that money out. We want them to go back up again. In the meantime, use this equity you've got over here. Use this to manage your lifestyle or whatever. So anyways, lots of things you can use for this. No monthly payments required. A lot of investment options as well. Get your financial planner involved. They love this. I actually just recently got approved for CE for financial planners and insurance agents. So this is kind of a big thing for them too. So you're never too old to set another goal or to dream a new dream. So thank you. Here's my contact info. For those of you online, just email me those keywords. And again, make sure I have your name, email, and your license number. And we got, did all of you guys sign this one?
Yeah, Tony's not licensed.
Oh, okay.
No CE.
We gotta get you licensed.
Yeah.
Okay.
I just wanna see who we got on
I'm
here.
just waiting.
Hi, Karen, Sherry, Robert, you guys online, you have any questions?
No, I don't think so. Great training as always. Thanks, Spencer.
You.
Hey, I got a suggestion for what you guys that could use this to get more business. Why not set up appointments at the senior communities, the community centers where people hang out and they play pinochle
Yeah.
and pickleball and all that kind of stuff. Not to teach what he teaches, but to maybe get their minds thinking. I've never done this. I was just thinking, brainstorming here, how to utilize this to get more business. These examples are a great way. It's like, oh, I didn't know you could do that. I didn't know you could do that. I didn't know you could do that. So just like opening up that, hey, did you know that you could do this? That would like be phase one of a relationship maybe you could make with some people. And then phase two would be to set up that consultation with Spencer. Maybe it would even morph into a situation where Spencer comes with you and you do a double-sided presentation and do more education with it. But maybe if you just want to get them thinking about the possibilities of what they could do with the equity in their home, or being able to go buy another home, change their lifestyle, and then follow up with an appointment with Spencer to kind of look at their individual unique situation, I think it'd be a good tag team on this.
Yeah, yeah, I'm happy to, if you want me to come along to explain some potential clients of yours or whatnot, I'm happy to come along and help answer questions. And, you know, even, you know, if it doesn't happen 6 months or 2 years from now, I don't care. Let's just educate people and get them thinking about it.
Start relationships and offer value.
Yes.
Yeah.
And it doesn't-
Imagine how many people just, we didn't know, it opened our eyes today,
Yeah.
it just boom, but.
Yeah.
And you guys been in this industry for a long time, just, yeah, imagine there's people like your senior community centers. No idea.
Well, that's just where they tend to hang out, but I mean,
Yeah.
even your social media
Yeah.
and the younger generation, they have parents.
Yeah.
They have aunts and uncles, they
Yeah.
have grandparents, they have people in a situation, and maybe just trying to start that dialogue and gauge some interest that way could connect you
Yeah.
through your normal sphere of people that you're communicating
For
with.
sure.
Later, that's why I like these trainings, is it gives us those talking points, right? It's like, hey, guess what I found out today? And then somebody will say, well, my mom's on a fixed income. Pose those questions like he did the whole first part of his presentation.
Yeah.
Problem.
Yeah.
And we're asking all these questions. I'll get to the good stuff.
Yeah.
But the problems is, are you in this situation, or do you know somebody over the age of 62 that has this, problem? Are they on a fixed income, not enough living expenses, but they have equity in their home? Let's have a dialogue. And,